All right, so prayerfully everyone can hear me. And we have this webinar recorded for those who may be joining this experience for the first time. I'm your local financial advisor. My name is marcus.rather, working as a part of Cetera Investors. And you can see I'm affiliated with two offices, one located in Charlotte, North Carolina, and the other in my home state, Virginia, located in Glen Allen, Virginia. Typically, once a quarter, we like to take a moment to identify what things have occurred in the market and in the economy, and provide some perspective in terms of long-term view of what we can see happening as a result of some current events. If this is your first time joining us, we'll be sticking to the Cetera Investment Management perspective of the market and the outlook. We are focusing on three themes starting off from the top of the year that we'll be going through. Now, I do want to mention that this presentation was put together before last week. So a lot of major headlines that have occurred may not be in this presentation. One being the current government shutdown that was effective the end of September and the 1st of October. While we've seen that shutdown, last a bit longer than some may have expected, there hasn't been any major reaction in the market as a result of that. Some articles that I've read say with the potential reimbursement from the furlough, there may not be a drastic impact on gross domestic product, and therefore there's not a major sell-off in the market. But should we see a sacrifice of earnings for those people, that could have some type of impact on GDP for this quarter that we're in. Also, over the weekend or leading into the weekend, we saw rhetoric, I'd say, nothing bill-wise that have been passed or implemented, but we have heard tariffs or trade tensions between us, the United States, and China, which have, had an impact on the market. We saw a sell-off on Friday, somewhat of a resurgence on Monday, and today we still saw a downturn in the market as well. So there's some volatility centered around some of the, I would say, bargaining or whatever the deal arrangements are between the United States and China. Those two things being said or being in mind, it sticks with some of the themes of what Cetera saw in the early part of this year. So the three themes that Cetera introduced was one, we believe that there was a moderating economy. So starting off at the beginning of the year, we expected that the economy will moderate. So that's not to say that we would experience a recession, or if a recession were to occur, that'd be a severe recession. But we did see that there would be some type of moderation economically. Number two, there was a central theme focused around the Federal Reserve, with the Federal Reserve becoming more of a foe and less than a friend. And then the third would have been volatility, specifically diversification being rewarded. So if you recall, going into this year, these three themes that we're highlighting, we found that these three themes are holding true, right? If we look at the fourth quarter, we expect economic data to continue to moderate, especially labor data, which we'll focus on a lot with this moderating economy theme. And the Fed, who was reluctant to cut rates, finally started and is expected to continue. So in the third quarter of this year, we have seen one Federal Reserve rate cut. The market was expecting several, so more than two. As such, the market is priced in more than two. The Fed has expected about two, or no more than two, for the year. And a third theme that we've seen that has held true is diversification has been rewarded, yet we do expect volatility to emerge at some point, given the high valuations and the sharp rebound in stocks. So starting off with the moderation of the economy, right? Data has been moderating, but we found that investors are beginning to worry about the labor market moderation. Will it continue, and at what point does it become a problem? So as we look at the weak job growth, right? In the first quarter, GDP growth turned negative, and job growth saw a sharpened downward revision that carried into the second quarter of the year. So on the far right of your screen, centered around 2025, if you follow my cursor, you can see the monthly employment growth starting at the top part of the year. We have seen some growth, and then shortly it's significantly fallen off. If we look at that from a different chart or a different perspective, if we look at average monthly non-farm payroll growth, we see that year to date, it's significantly less than in prior years. The average monthly non-farm payroll growth being 75 per month, or measured in 75 per month in thousands, opposed to right shortly after the pandemic, the highest point being 603,000 non-farm payroll growth, new jobs started per month. Now, as we're looking at job seekers, there are more job seekers than job openings at this point. Job openings fell to a cycle low of 7.18 million, marking the first time since April of 2021 that there were fewer job openings than unemployed job seekers. So before the pandemic, the ratio of job openings to unemployed job seekers stood at roughly 1.2. While job gains have slowed significantly, we have not seen widespread layoffs. And again, that's not to say that layoffs have not occurred to this point. We've seen layoffs from tech companies, tech industries, other industries, and specifically largely the federal government. But we haven't seen widespread layoffs across the entire labor market. When you take a look at hourly earnings, there was a year-over-year expansion in hourly earnings. The average annual earnings rose 3.7% year over year from August 2024 to August 2025. However, that is the second weakest annual gain in this cycle. So over the past 3 months, wages have increased at 3.4% annual pace, gradually easing towards the pre-pandemic average of 3.2. Softer labor market conditions are tempering wage growth, which may help keep a lid on inflation. Now we look at entry-level unemployment. The unemployment rate for both young people, those coming out of college, and those with less educational attainment is starting to increase, such as among 20 to 24-year-olds and those without high school degrees over the age of 25, which is on the next slide that we're looking at now. So when we look at unemployment discrepancies, right, there's a larger discrepancy, that line in purple, unemployment rate 25 years of age and over with less than a high school diploma. We see that there's higher unemployment for that category of citizens opposed to those 25 and older with at least a high school graduate, but no college. Some college, less than a bachelor's degree, or in the yellow, 25 and older with a bachelor's degree and higher. You're starting to see the disparity in unemployment based on the level of education. So the divergence underscores the importance of looking beyond the headline unemployment figures. While not yet flashing red, these developments warrant close monitoring as they could influence consumer demand and corporate earnings in early 2026. Now, if we were to look outside of the labor market and more holistically, while the labor market appears to be softening, the broader economy appears to be holding up. So there are some mixed signals that still linger. Traditional recession indicators are signaling a moderate risk of a downturn, as reflected by the recession riskometer. Positively, the economic trend signal has shifted from negative to stable, suggesting a more favorable near-term outlook. So conflicting data, right? You can see the recession risk for things like manufacturing, building permits, which are future looking, and the consumer sentiment, which are how consumers feel. The recession risk is moderate and the trend signal is stable. But you can see services, industrial production, things along those lines, they're low. The only two high areas are temporary help employment, which would be representative of the labor market as well, and leading economic index, the year-over-year change. So what would the impact of tariffs be, specifically from an industrial production standpoint? So tariffs can be seen as helping industrial production. This is something we will continue to watch. As we've seen that uptick compared to 2024, we see higher measurements in year-over-year change for 2025. In terms of retail sales, they've been uneven throughout the first half of this year, yet they are climbing despite some dreary consumer surveys. So we do see a year-over-year positive change in U.S. retail sales, even in the midst of a trade tension and tariffs. Now, Federal Reserve, following that second theme, right? Will we continue to see the Federal Reserve be more of a foe than a friend? with weakening labor market, the Fed has shifted its focus from inflation, which their goal was to get inflation back down to their 2% historical range. So now that they're shifting focus from inflation to the labor market, they did introduce a interest rate cut, and there may be some future rate cuts on the horizon. The Federal Reserve cut interest rates for the first time since last December, signaling a shift in policy to support a weakening labor market. Despite a recent uptick in inflationary pressures, the Fed opted to ease rates to prioritize labor market concerns. The core PCE, which is one of the measures of inflation, the Fed's preferred inflation gauge remains above the 2% long term. While tariffs have contributed to near-term inflation pressures, their impact is expected to fade over time. So if we look at the Fed rate target, which is measured in the darker green, and the core PCE price index, which is in lighter blue, you can see that there is some measure between the long-term rate and where inflation is increasing year over year. And the dark gray, you can see recessionary periods where they somewhat get close to intersecting during those recessionary periods. So there is a positive sign between where the funds rates currently are, or the Fed fund range is currently, opposed to the core PCE price index on an annual rate. It is below 3, but not quite yet at 2%. Now, if rate cuts were to continue, we can see inflation over the last 3 months, and we see that starting to pick up from the Fed's target. But the longer 6 and 12-month averages remain around 3%. Inflation still seems to moderate right at 3%. So in the dark green, you see the 1-year percent change. The 1-year change is right beneath 3%, right at 2.9. If we look at the 6% month change, the light blue, that's right at 3. And then in the yellow, it's also at 3, which measures the 3-month change. Now, do want to mention when we talk about inflation, for those that may say, hey, I never want inflation to happen. Inflation should always be at 0. Can't quite have deflation. It's not always the best thing to have deflation or stagflation per se. But inflation is measuring the percent change in the price from one period to another. So prices are always going to change, right? That's just as things grow, as supply and demand dictate oftentimes the prices of goods and services. We know that there's going to be a price change. What the Federal Reserve is aiming to do is moderate or limit how much of a percentage change we see over a given period of time. So they're trying to manage what rate of increase do we have in cost of goods and services. Now, you also see on the chart, it's excluding food and energy prices because those can be very fickle. So they do remove that in the core PCE measurement of inflation. So currently the Fed's fund rate is in a range of 4.0 to 4.25. Both the markets and the Fed appear to think 2 more cuts before the year end are in the cards. So it is possible that we could see 2 additional cuts right before the end of the year, but it's all data driven. So the Fed will be dissecting or receiving information, which currently what is impacted by data is the government shutdown. So there is a bit of delay with some data and some metrics that the Federal Reserve would use to, make their decisions. Finally, the third theme, which is volatility, which we expect volatility along the way throughout the end of this year and moving into 2026. And this, for those that may have been joining us for many times, we always talk about volatility. You may ask, well, when is there never a period of volatility? And the answer is there's always some type of volatility. The thing with volatility is at what rate or what range do we experience volatility? Is volatility going to be severe where you have days such as over the weekend where you can have 2 or 3%, 5% change in a matter of days versus something that's a bit more gradual and steady? So volatility in this sense, we're saying, yes, it always happens in the market, but will there be periods where we have higher volatility, where we have more major swings based on data, based on headlines, based on other things, or will we possibly see more of a calm and steady market? So we do expect a bit more of higher volatility towards the end of this quarter, end of this year, and moving into the new year. So since stocks bottomed early in April, there has been what is called a V-shaped market recovery, as you can see on the screen. Though valuations are back at elevated levels, the S&P 500 is currently trading at 22.7 times forward earnings, significantly above the 20-year average of 16.4. So when you hear me or other professionals say that the market may be overvalued, based on average, the market will trade at 16.4% of its earnings. Currently, it's trading at 22.7. So we do see high valuations in the general market, in this case, measured by the S&P 500. A lot of that can be attributed to the expansion and the boom in artificial intelligence. That technology, AI-driven market is really accounting for a major part or a major amount of the growth that we're seeing in the broad market. So earlier this year, when we talked about diversification, how we talked about diversification was making sure that we don't have what we call concentration risk. Thus, making sure that the investments that you have in your portfolio, one, are not 100% correlated to one another. For example, if you have mostly large cap stocks, even though you may have different companies, if they're highly correlated to one another, then if we do see some type of downturn, if we see a regression in the market, all of those stocks or all of those holdings would be negatively impacted. Something with a bit lower correlation or even a negative correlation may have the opposite effect. So in a regressing or receding market, you actually may have expansion because of the correlation that this asset, that this investment has to the broader market. So what we're looking at on this chart, if we're looking at projected 2026 earnings growth, while earnings expectations were dampened after Liberation Day, which occurred in April, when President Trump raised tariffs, corporate earnings came in ahead of expectations in the second quarter, and corporate guidance was generally positive. With earnings optimism rising again, there will be a higher hurdle to exceed expectations. This is particularly true for the high-performing AI-related mega-cap tech stocks. Tariffs elevate government revenue. So one of the biggest potential disruptions to the market and the economy in the fourth quarter could be the U.S. Supreme Court's hearing regarding tariffs. It's set to take place in early November, in which the court could rule as early as the end of 2025, but the decision may also extend into the new year. It is conceivable, although legal experts are mixed on the topic, that the court could strike down some of the tariffs, especially the broader sweeping reciprocal tariffs. This could provide near-term volatility as investors try to understand the ruling, which may not be binary. They could allow past tariffs to stick and some future tariffs, allowing the administration time to find another legal pathway to allow them. So there are some revenues that we can get that could help in some ways, but with the stickiness and the transition, it could also have a negative impact. As we're looking at valuations, right, going back to the S&P as an indicator or as a benchmark, the forward price to earnings ratio is 16.3 for the S&P mid-cap 400 and 15.5 for the S&P small cap 600. Even within the equally weighted S&P 500 index, there is discrepancy. The high valuations are being driven primarily by the S&P 500's biggest companies. Again, mentioning back to that concentration risk, where a lot of the growth that's occurring in the market is being driven by big names. So call that big top heavy, right? So if we look at American Association for Individual Investors survey, that's sentiment, that's what the average investor would believe. This could give credence. There is more room to run and momentum could continue. If everyone was very bullish, this could be a contrarian sign of a market correction. So you can see that there's a larger spread between bulls and bears for the average investor. So there's mixed feelings, but we can see stocks, how they have performed thus far this year. We've hit numerous record highs throughout 2025. Shifting gears from stocks into bonds, right? We always want to talk about a different asset class. While bonds are being overshadowed by equities from an expansion standpoint, they are quietly having a good year. The aggregate bond index is up 6.5% year to date as of late September. As seen here, the 10-year Treasury yield, which this is not as impacted by the Federal Reserve movement, but as measured here by the 10-year yield, started 2025 at over 4.5% before easing around to 4%, adding price appreciation to decent returns investors are already receiving from the bond yield. Bond yields are expected to stay near long-term equilibrium levels, roughly equal to real GDP growth plus inflation, suggesting stable return potential unless inflation or growth expectations shift meaningfully. So when you typically see a decrease in the yield, or if you see a decrease in interest rates, you oftentimes will have an appreciation in the price or the value of a bond. So what we could see in this climate, as the Federal Reserve cuts rates, should they continue to cut interest rates, you may see an appreciation in the value of the bonds that you may own, but also the yield that you're getting. If they do hold steady or if they happen to appreciate, you may have some dividends that add to your total yield for owning that bond. So I do thank you for joining this experience, and I'll make sure that I show the disclosure slide here at the end. If there are any questions for anything that you've heard to this point, please feel free to submit those to the Q&A feature. So as I wait for questions to come in, I do want to share an additional thing that hopefully comes to your screen. For those who are in attendance today, Cetera does have a written market outlook where they provide a bit more descriptive information on how they put together this presentation. If you would like a PDF copy of that, please submit that or send your request to my email address, which can be found back on the title slide. So I will just pause. Sure you can hear all the clicking there. So for those who would like a PDF copy of the market outlook for the fourth quarter, feel free to send your request to marcus.rather at CeteraInvestors.com or contact me at my branch office, 804-346-4670. So to not take any more of your time, I will bid you all a good afternoon. Thank you again for joining this final market outlook for the year of 2025. And I look forward to seeing you at the top part of 2026. Everyone have a wonderful evening.